the capital markets haven't caught up with, I think, where the industry is. And this is not just about flex space and amenities and how do I value a management contract versus a JV versus a creative lease versus a regular lease with companies like WeWork or Convene or Industrious or whomever. I think it's actually bigger than that.
This is the Real Estate Interview, a series of in-depth conversations with those making a dent in the real estate business. I'm your host, Hiten Samtani.
And my guest today is Ryan Simonetti. He's the co-founder and CEO of Convene. Convene is one of the leading players in the flex office space, and they've recently made a big push into virtual conferences and events. Convene has raised, just think about north of $250 million from the likes of Brookfield and Durst. If you add debt, there's a lot more money in there. And they control about 1.2 million square feet across nearly 36 locations. I wanted to, chat with Ryan because he sits at the intersection of many things I've been thinking about quite a bit. Fintech and its applicability to commercial real estate, branded space as a service, the future of landlord and startup partnerships, and a lot more. So Ryan, this has been a long time coming. Thank you for being with The Real Deal.
Looking forward to a great conversation.
Now, the first thing I see is Convene Studio, and I see this sort of really big concerted effort to get into the hybrid event space. We just had our big real estate event in Miami, 4,000 people. That magic, I was like, wow, I missed that. And that cannot be replicated. But there is something to be said about the scalability, accessibility of virtual events. And you guys are trying to marry both.
Well, first, I want to validate what you said, which is there's nothing like face-to-face. It's been exciting for us to see, over the last couple months in particular, you're really seeing our spaces buzzing again. We at Convene, we do believe that the future of meetings and events is hybrid. More than 89% of the meeting planners that we've surveyed are expecting to host hybrid events in 2022 and believe that hybrid events are going to be a key part of their strategy moving forward. As you mentioned, this has been a big area of focus for us. We launched a new service offering called Convene Studio, which is both a virtual event software experience, but the real magic in it is a entire production services kind of white glove service where we have dedicated centralized teams that actually handhold and produce that event, which from talking to our clients, that's the real value is in that kind of human support to make those events really come to life in a special way.
But how do you replicate? So I can understand how you can replicate sort of showing the panel and stuff. How do you replicate the let's go chat for a minute? Let's make a deal happen.
Companies like Hiten and Welcome and Bizibo and others, and all of us are thinking about it the same way, which is how do you leverage chat? How do you leverage one-on-one video? How do you leverage kind of breakout experiences, including those that attendees can technically create impromptu on the fly, and through text and video, can you, to the best of your ability, try and replicate some of the serendipitous stuff that happens at these events? And look, that's the playbook that we're all running. I do think the technology around that experience will continue to improve, and hopefully at some point over the next few years, there's better parity where you can start to replicate some of the networking experience that is why a lot of us go to physical events and replicate that virtually. But I'll be honest that the technology is not there yet. Where we see the real value for our clients that are hosting hybrid events is how does it allow you to bring speakers in that you might not have the ability to reach,
right?
From a content perspective. And also, look, the beauty of virtual is the reach, right?
We've talked a lot, and a lot of people have talked about how the office has become a branding tool, a recruitment tool. We've seen the likes of the massive tech companies spend billions of dollars on build outs because for a long time, your physical office has been thought about as a recruiting draw, right? That didn't go away. But what I was curious about is how well a company executes its virtual strategy, its meeting strategy, is that now becoming a factor in recruitment, in retention of talent as well? Is there some level of consulting you're doing on, okay, how would we manage the flow of people? How would we manage the training?
I think by nature of the relationship that we have with our customers and the fact that, all of us are trying to figure this out, right? Every CEO, this is front and center, every head of workplace strategy, every chief people officer. So I think by default, everyone is open and communicating in a way and in a very collaborative way. Do we have plans to launch that as a service? No. But do I think that there's a huge opportunity both through technology as well as new kind of consultative services to help companies figure out how they're going to need to not just manage, but also measure what success looks like in this new world? 100%. And, there's definitely founders out there I know that are trying to tackle this problem today.
Design is a big part of what you do. What I would be interested in is how much of a role or how much of a growing emphasis is there on health and wellness? So there is a realization that landlords need to take a little bit more ownership about spaces to empower, sort of create a health and wellness perspective for those occupiers. There's a lot more emphasis on sustainability. There's a lot more emphasis on natural light and wellness. How are you thinking about that at Convene?
There's more pressure on all of us, right? Yeah. Whether you're a company trying to get people to come back to the office, whether you're a landlord that's trying to get tenants back into your building, or you're trying to lease up a building, or service providers like Convene, we have to deliver an experience that people want to come to. And so that means the table stakes are technically higher for all of us. It's not just about designing beautiful spaces. It's not just about a great food and beverage experience being integrated. It's not just about great hospitality and friendly people that really care about our customers and deliver service with a smile. It's not just about the technology experience. It's about all of those things coming together to really truly create an end-to-end premium workday experience for our clients.
One of the things I find a little confusing about the commercial real estate industry, for how big it is and how rich it is there don't seem to be too many standardized metrics about what constitutes good quality. So what is a building that has a real sort of wellness score? What is a building that has real sustainability? There have been some efforts made. I've seen Measurable is doing some interesting work around there, but there's a lot of horseshit out there too. There's a lot of fake standards.
Look, I think there's some platforms out there now like the Wellbeing Standard and what Ari and his team are doing at Wired Score, which I think to some extent it wants to hold the industry accountable to a standard, right? From a delivery standpoint. I think the challenge that the industry has is we don't really view ourselves as consumer businesses, right? There's no Yelp 5-star, 4-star, 3-star,
Exactly.
2-star.
Right.
We're not the hotel industry where I know that there's a difference between a 5-star brand, a 4-star, 3-star, 2-star, and a 1-star. And what's exciting about, I think, where the industry is heading and what companies like Convene are doing is we're consumerizing a real estate experience, right? It's like the consumerization of the industry is happening. And part of those standards are going to be created by brands, because brands have set expectations for their consumers on what those standards should be. And so, for example, with Convene, we have plenty of standards that we hold ourselves accountable to, everything from customer experience metrics to physical space and typology metrics to uptime on our network infrastructure. And what do we view as an acceptable time period that it takes one of our guests to go through our welcome experience? And so my hope is that as the industry becomes more consumer focused, by default, we'll start to create standards that define success outside of Class A, Class B, Class C.
Because those don't mean anything anymore.
They don't mean anything. Well, they definitely don't mean anything to the consumer.
Right.
Yeah, that's for sure. Now, I think more broadly speaking, though, you're bringing up something interesting, and honestly, I've been making, as you know, and we've talked about, I'm a pretty active early stage investor, and I've definitely been investing more of my own personal dollars into the data side of the industry, broadly speaking, because the reality is what gets measured gets managed. And I hate to say it, but the real estate industry has a lot of data, but that data is very opaque. It's not transparent. And I don't really think the industry knows what to do with that data. And so I see a huge opportunity. And there's a lot of companies, especially startup companies out there, they're starting to tackle this, to bring better transparency and insights so that the industry can leverage this data to make our buildings safer, make them more efficient, make them more sustainable for asset owners and investors, ultimately make them more profitable. And I think what I'm most excited about is it will actually allow us to make those buildings more experiential and more experiential in a personalized way. Like my vision for Convene is that we get so good at this from a data standpoint that we can actually start to anticipate and personalize experiences, not just for like our customer, but literally individual users in space.
If I go to the Four Seasons as opposed to Best Western, I know what I'm getting. So you're talking about companies like yours that have a brand, stand for something. What about the landlords themselves? So, I think of SL Green or Vornado. The reason their assets mean something is really the location and the quality of the asset. Do you think there'll be a time when an SL Green building, just by being an SL Green building, is more or less valuable than a counterpart?
I think that landlords would love to and should be investing heavily in building their own brands, similar to the way that companies like Convene and WeWork and Industrious. I was blown away with the stats. Talk about the power of brand. WeWork accounted for, it was crazy. I can't remember what the stat was, but it was something like 35% or 40% of all leasing volume in New York was deals done with WeWork.
Right.
Can I tell you what that is? That's called the power of brand, right? And distribution. So look, I believe landlords are investing in this. I think that this is obviously a focus for them, but it's going to be tough. It's going to be tough to compete with companies like us that are building consumer-facing brands that know how to sell and market for a living. It's a different business. And that's why I've always been a big proponent of the SL Greens of the world and the Relateds and the Vornados and the Brookfields partnering with companies like us, because we're never going to be as good at what they do as they are. And the reality is, no matter how hard they try, they will never be as good at what we do. And I think the opportunity there is to acknowledge that and to really find ways to work together and leverage the best of both of your competencies and capabilities.
We are seeing some interesting moves being made, maybe landlords too, but some of the big CRE giants, the service providers. I'm thinking of CBRE's stake in Industrious, right? That's an interesting move. Where do you think that kind of thing will happen when you have a company that has access to the capital markets, has a ton of experience and manpower in this area, and is buying into this model that you and your rivals are putting forward?
I'm going to give everyone a little look into a really interesting thing that's happening in the industry right now. There's a war going on today, and it's not between the U.S. and China figuring out who's going to be world dominant 10 years from now. There's a battle going on right now between the vertically integrated owner-operator that manages their own asset, the property management and facility services companies, the CBREs, the JLLs, the Cushmans, the Newmarks, the integrated facilities and hospitality services companies like Compass Group, Aramark, ISS, Sodexo, and the companies like Convene, the WeWorks, the Industriouses, the Foras, the Convenes of the world, because the reality is what all of us do is converging. And the reality is like Convene really is a new type of branded property management and hospitality services platform. We are an integrated FM services provider. And what's happening right now is you're seeing this turf war play out, and you have some people who are acquiring platforms. You have other people that are partnering and investing in platforms like what Cushman did with WeWork. You've obviously got CBRE in the industrious deal. You've got companies like Tishman Speyer building their own capability. You have companies like Hines who are vertically integrated property managers as well as asset owners and investors building capability. So I think it's going to be a really interesting 3 to 4 years seeing how this all plays out. And I do think that we will see consolidation and we'll continue to see deeper and deeper alignment between the companies like us and either the vertically integrated owner operator or some of these bigger real estate services companies who, right or wrong, need the capability that we've built.
They're starting to take Proptech very seriously as well, right?
Real estate is one of the largest asset classes in the world. It has been historically slow to evolve and change. Much of what it does is still antiquated. It's highly fragmented. On the spectrum of risk on versus risk off, it's more in the risk off camp. And what's happening in real estate today is not too different than what's been happening in financial services, healthcare, and insurance, which are 3 industries that have and continue to see a tremendous amount of new technology and new business models disrupting incumbents, period, full stop. And the same thing is happening today in real estate, right? Like real estate is the last major industry domino, I think, to fall if you look at like finance, insurance, and healthcare. And that's really exciting. And that's why we're seeing the venture dollars. That's why we're seeing the brains, like the quality of founders that are starting businesses in and around Proptech and real estate technology today is it's unbelievable. You know, we're getting the Stanford grads, the MIT grads, I mean, people that were primarily going into either enterprise SaaS or consumer facing stuff are flooding into the industry to tackle a lot of the problems we have. And I fundamentally believe over the next 10 to 20 years that technology and new business model innovation will fundamentally change how real estate is designed and built, how it is sold and marketed, how it is serviced and operated, and how it is financed.
I was listening to a great interview with Alex Rampel, I believe from A16Z, and he was talking about all these fintech applications and logistics and transportation. What's your take on the real estate space?
I'm personally very fascinated with the intersection of real estate, technology, and finance. Which to me is the line or blurring line that I'm seeing between fintech, proptech, if you want to think about it in like pure venture / angel terms. And what's interesting is if I go back to my 4 buckets, right? How real estate is sold and marketed, how real estate is designed and built, how real estate is serviced and operated, how real estate is financed. There is a massive opportunity for fintech-oriented solutions to enable a lot of the movement of money and payments across that entire value chain, across every asset class. So I think you're going to see more and more of the movement of money, right? Which at the end of the day, every asset class has a transaction. Right? You buy it, you sell it, you refinance it. Every month you're getting paid by tenants through some means. I think from acquisitions to finance to rent payments, all of this stuff is going to be digitized. Think about Web 3.0 applications via blockchain and some of these new technologies and what that means here. Things like, look at what Built is doing within construction finance. Look at platforms like flex until and really disrupting the payday lending business, where most people don't realize, but half of all payday goes to cover living expenses, most likely rent expenses, and creating the flexibility for consumers to have variability because not everyone gets paid on the first of the month. And then you've got companies like Otso, which is a really interesting company now that's rethinking the lease security deposit for commercial office leases, because what company wants to park cash in an LC making no interest when that money could be reinvested in the business?
On the resi side, in fintech, I've seen some like Open Doors doing a lot of innovation on the capital market side in terms of how they buy and finance homes. They've been able to tap into the bond market in a really interesting way. Are you seeing anything on the CRE side, sort of larger scale shifts in how money is flowing in?
In a former life, I was in the structured finance business.
Gramercy Capital, the same Gramercy Capital that I believe Mark Holliday came out of.
So SL Green was our largest investor and largest shareholder. But no, look, I think that if you look at what's happening in residential lending across the chain, I think that there's an equally interesting opportunity within commercial finance that has yet to be solved. And so I think that we'll see a lot of innovation from software to data to new types of securitized products, especially as we see new and emerging asset classes like SFR and some of this other stuff. So yeah, that's another part of the market that I'm keeping a close eye on. And if anyone's out there starting stuff that's in that vertical, please talk to me. I'm definitely looking at making a few bets in that space.
The model of leasing is changing. That traditional 10-year lease is no longer necessarily the default way. You guys and many others have innovated around that model. There's more partnerships. I wonder with some of these changes, how asset valuations might be affected. If you have a lease or you have 20 leases in a building, the cash flows are predictable. You get a sense of how to value an asset and then how to value an asset class. How do you do it in this sort of muddled world of lease agreements, partnership agreements, income sharing agreements? It's all a bit of an alphabet soup. So I wonder how like the debt markets can value buildings in this environment.
I know I've been preaching this for a very long time. I know Jamie at Industrious has talked a lot about this, as well have a lot of our peers and CEOs, especially with the flex-based companies. The capital markets haven't caught up with, I think, where the industry is. And this is not just about flex space and amenities and how do I value a management contract versus a JV versus a creative lease versus a regular lease with companies like WeWork or Convene or Industrious or whomever. I think it's actually bigger than that with an office, which is, if you look at the average lease term today, the average lease term in commercial office real estate used to be north of 10 years. Last time I checked, I think it was barely 5. And I don't think people pay enough attention to this, is the world is becoming increasingly complicated and increasingly volatile, and the life cycle of businesses is getting shorter and shorter. So the average life cycle of a business today in the United States, birth to death, is like under 7 years. And so it makes sense that if a company is really only going to be alive before it's either sold to somebody else or whatever is going to be 7 years, then sure,
they shouldn't be paying rent for 10, right? Yeah.
Why would you pay rent for 10? And look, I'm a CEO of a company. Any CEO you talk to that has their wits about them is going to say, I want every one of my expenses to be variable with revenue. Literally. And one of the things driving the gig economy is that too, right? Companies like us, I'd rather, instead of hiring X full-time employees, I can tap into the gig ecosystem and I can project-based staff work that needs to get done at the company. So
and the amazing thing is
that same mindset is coming to real estate, right?
And
like,
the amazing thing, Ryan, is you could do that. You used to be able to do that sort of at the cog in the wheel level. Now you can do that at an elite level. You can bring in top talent for a specific thing and then part ways. It's incredible. And that opens up so many things.
You can get a fractional chief people officer, a fractional CFO, a fractional head of development, a fractional head of engineering. You can parachute in some of the most talented people you've ever met in your life to launch a new product for you for 6 to 12 months. And then they parachute out to the next thing. So I just think real estate has to catch up with where businesses and the reality of the world is, which is companies are going to want more and more flexibility.
How is it playing out in financing buildings? When you look across, the Midtown District or Grand Central, do you just see a bunch of question marks in the air?
Look, I think today, there's probably question marks, right? How would you value something today? Here's how we would value Convene, right? As a percentage of a building is, what's the duration of the revenue? What's the yield on the revenue? And then over a certain period of time, if we've demonstrated that profitability for a certain window of time, 2 years, 3 years, why should that really be valued any differently? Okay, fine. Maybe it's 50 basis points wide or 25 basis points wide. The reality is if you go back to Convene, we typically go into buildings that are either new development or going through some sort of value add repositioning. Because we view ourselves as a strategic partner to a landlord. We view ourselves as a strategic ally in leasing up a building and actually changing the metrics of that. So improved velocity, overall improved occupancy. If you have a highly amenitized building, we're seeing the flight to quality today. You should get paid a premium for a quality asset, right? Which we've seen in our portfolio. And then also your customer should be stickier in a building that has Convene, because if a tenant moves in and we're delivering them a great experience with the landlord, and oh, by the way, when they took space in the building, they decided not to build their own amenity space or their own large training room, and they're now outsourcing to us and the landlord technically in the building, you've created a stickier relationship. And what we've seen is that the buildings that have partnered with Convene in those situations on a relative basis have outperformed their peer set in the metrics that matter in the Argus model, which ultimately drives valuation. And so, I think the capital markets and the lending community in particular is working on figuring out, what's the right cap rate? What's the right risk premium to put on it? Does that change if Convene's 5% of a building or 10% of a building or 20% of the building? And I believe over the next 3 to 5 years, the capital markets will catch up, as will the lending community. And I think there'll be a lot of clarity on valuation frameworks and how this stuff really should be priced. It's been done in other industries, right? It's done in the hotel industry, which is nightly rentals. It's done in multifamily. SFR is no different. Office will figure it out. Mixed use buildings, you've got, multi-asset use in a single building. So it's going to happen. It's just, look, everything starts with the team, right? And, being a founder is hard. Transitioning from a founder to a CEO and scaling a business is even harder. And so I think finding a team that, one, has a vision, has a clearly defined purpose, are good human beings with a really strong core set of values, because that ultimately will be the foundation of that organization's culture. That's like first check. And then I think from an opportunity standpoint, as I said, I'm looking for this intersection of real estate, technology, and finance. So something that's touching those three things. Today, I'm very focused, obviously, on data. I have known Michael and the team at CompStack for a long time and have been just so impressed with their resiliency and determination in what they built. And I look for markets from a TAM standpoint that, have the ability to be really significant businesses. And then one of my little hacks is I typically won't invest in a business or an idea that I don't believe has a natural takeout at some point in the future. So some of my best investments to date have been businesses that also would make a ton of sense as part of a bigger platform or bigger solution. And those businesses have gotten acquired by strategics at great numbers. And as an investor, that creates a lot of downside protection and also a path to liquidity kind of earlier on in a company's life cycle before they've raised a ton of cash.
When you look at these founders now operating in a space that has a lot more visibility, a lot more capital, do you sort of think back to your start? And man, when I was doing this, there was nothing.
Well, I mean, I laugh about it. When I started Convene in 2009, first of all, it was the middle of a financial crisis. And one, nobody was investing in real estate. Two, forget about trying to raise capital for a new business model that had never been done or tested before in the real estate industry, let alone in the hospitality side of the industry. So obviously I started Convene at a very different point in time. At that time, there was no real venture capital ecosystem. A lot of the generalist VCs that had invested in real estate technology and that kind of first generation of companies, most of those investments didn't work out so well. And most generalist VCs were, you said, oh, I got an idea for the real estate industry, and you didn't even get the meeting. And a lot of that was because, one, the industry had been historically slow to adopt. Two, the sales cycles, especially on the B2B side of the industry, are extremely long. And businesses had struggled to sell into the large asset managers and platforms that really control a significant piece of, let's call it, the non-long tail of the market. And for all those reasons, there wasn't a ton of venture capital. And thankfully, you've got WeWork, you've got VTS, you've got Reonomy, you've got the ComStacks, you've got the Procores, there was a whole generation of companies that were started between 2009 and 2013. And then, you have this, the amazing work that Fifth Wall did, and Camber Creek, and, some of these others that really were able to create dedicated venture funds focused on the sector. And as part of that, we're able to get the big incumbents to be their limited partners, really creating almost outsourced corporate development and R&D type of infrastructure for the big asset owners, the big property management platforms, the big service providers.
And also
that changed the game.